Picture a machinist arriving at a factory gate on a cold Monday morning in 1931. The whistle does not blow. A foreman stands outside with a short list of names and tells the men that production has been cut again. There is no severance guarantee, no public office authorized to replace part of the missing wage, and no federal claim to file. By the time the machinist turns toward home, the entire financial structure of his family has changed. The rent will still be due. The grocer will still expect payment. The coal bin will still be emptying. But the weekly wage that held those obligations together has vanished in a single conversation. Today, a worker who loses a covered job may qualify for temporary unemployment benefits. Before 1935, America had no nationwide federal-state system built to provide that bridge. A layoff was usually treated as private bad luck, a local charity problem, or evidence that the worker had somehow failed. The system that replaced that world was not created by simply opening a federal office and mailing checks. First, Americans had to discover why families, unions, charities, employers, cities, and even states could all fail at the same time. Organized labor had to abandon its own opposition to unemployment insurance. And Washington had to invent a tax that states were legally free to resist, but economically could not afford to ignore. That hidden mechanism is why unemployment insurance exists in every state today. So what actually happened when an American lost a job before that system existed? The answer depended on the decade, the city, the family, and how long the unemployment lasted. In a small community during a short downturn, old forms of support could bend without breaking. During a national collapse, they failed together. The story begins with the difference between one person being unable to find work and an economy being unable to provide enough work for millions. For much of early American history, unemployment did not look the way it does now because most people did not depend entirely on a weekly industrial wage. A farm family could suffer crop failure, illness, debt, or falling prices, but work was distributed across land, seasons, household production, and relatives. Children and older family members contributed what they could. Food came partly from the land. Cash mattered, but survival did not depend on one envelope handed over every Friday. Industrialization changed that relationship. Work moved out of the household and into mills, mines, rail yards, packing houses, and factories. The shift increased productivity and created enormous wealth, but it also created a new vulnerability. A worker might own no land, produce no food, and possess no tools beyond the skill sold to an employer. The wage became the household's operating income. When the employer stopped buying that labor, rent, heat, clothing, and food were all threatened at once. Families responded with whatever private resources they could reach. Savings disappeared first. An unemployed brother moved into a sister's apartment. Adult children sent money home. A family rented out a room, took in laundry, repaired shoes, or sent teenagers into the labor market. A grocer might extend credit, and a landlord might delay eviction. When those arrangements ran out, furniture, watches, tools, wedding rings, and winter coats went to the pawn shop. Job loss was often survived by liquidating the household one object at a time. The economic fall was rarely immediate enough to look dramatic from the street. A family might remain in the same apartment for weeks while its position quietly deteriorated. Meals became thinner. Medical visits were postponed. Insurance policies lapsed. Children stopped taking the streetcar and walked farther to school. Respectable clothes were preserved for job interviews while everything else wore out. By the time a household appeared at a relief office, much of the private safety net had already been consumed. Mutual aid societies, churches, fraternal orders, labor unions, and a few employers created another layer of protection. Members paid dues while working and sometimes received food, medical assistance, or small out-of-work benefits after a layoff. Certain companies built reserves or guaranteed limited employment to prove that responsible business could solve the problem without government. These plans mattered to the workers lucky enough to belong to them, but by 1931 voluntary company and union programs together covered only about 116,000 people in a labor force, numbering tens of millions. The private plans also contained a fatal weakness. The employer, union, or mutual aid society collecting contributions was exposed to the same downturn as the worker. When orders collapsed and layoffs multiplied, company revenue fell, union dues disappeared, charitable donations shrank, and the benefit fund faced its largest claims at exactly the moment its financial base was weakest. A small pool could help a few members. It could not insure an entire industrial city against collapse. When private resources failed, an unemployed worker entered the world of poor relief. Towns, counties, cities, and private charities inherited systems shaped by older poor law traditions. The central question was not whether a person had worked and paid into a fund. It was whether the household had become sufficiently destitute to deserve aid. Assistance might arrive as groceries, coal, rent vouchers, or institutional care rather than cash, and every decision depended on local rules and official judgment. Applying for relief could mean opening every part of family life to inspection. A caseworker might ask about relatives, savings, furniture, health, rent, and the earnings of every person in the home. Families could be ordered to seek help from adult children before receiving public funds. Some communities still relied on settlement rules that decided which town legally owed support to a poor person. A worker who had moved to follow a factory job could discover that the new city did not consider him its responsibility, and the old one no longer wanted him back. The harshest form of assistance was indoor relief in an almshouse or poorhouse. By the early 20th century, many communities were moving away from placing able-bodied unemployed workers there, but the institution still shaped public fear. Entering meant surrendering privacy, accepting rigid rules, and carrying the label of pauper. Even outdoor relief delivered to a family at home could feel like a public declaration that the household had failed. Many workers delayed asking until hunger or eviction left no alternative. That system carried a deliberate stigma. Insurance treats a predictable loss as a risk financed in advance and gives a qualified person a defined claim. Relief treats a person as needy and asks an authority to decide how much help the household deserves. Before 1935, an unemployed wage earner reaching the public system was not usually treated as a worker temporarily separated from employment. He was treated as a poor person asking the community to support him. The arrangement could appear adequate when unemployment was brief and local. If one mill closed but another opened nearby, family credit might last until the next job. If only a few residents needed help, a church collection or municipal fund might cover the emergency. But industrial capitalism repeatedly produced panics in which factories closed across entire regions. The crises of 1873, 1893, and 1907 showed that a worker could be sober, skilled, and willing to work while no employer nearby was purchasing labor. During those downturns, the hierarchy of support failed in sequence. Savings vanished. Credit tightened. Relatives who might have helped were unemployed themselves. Union funds emptied. Charities received fewer donations while facing longer lines. Local governments spent more on relief while collecting less in taxes. The system did not fail because every family and charity had been irresponsible. It failed because every layer had been built to handle individual misfortune, not a synchronized economic shock. Earlier depressions had produced marches, emergency soup lines, and temporary public works, but reform faded when prosperity returned. The political memory of unemployment was short. Once factories reopened, mass joblessness again looked like an exceptional interruption rather than a permanent risk of industrial life. Insurance advocates kept proposing bills, and legislatures kept postponing them. The country repeatedly treated unemployment as a fire to extinguish after it started, not a hazard for which money should be reserved in advance. That is why unemployment insurance remained controversial even after earlier depressions. Critics feared that regular benefits would create dependence, reward idleness, or burden employers. Labor leaders often preferred the dignity of full wages through work and worried that a small government payment would normalize unemployment. States feared that acting first would raise costs for local businesses. And the federal government faced a constitutional puzzle. Employment law traditionally belonged to the states, but a national depression ignored state borders. European countries had already begun experimenting with compulsory unemployment insurance, including Great Britain in 1911. American reformers studied those systems, but the United States had a more decentralized political structure and a deeper suspicion of centralized social policy. The problem was becoming clear long before 1929. Short-term involuntary unemployment looked increasingly like an insurable risk. Mass unemployment still required relief and public work. America had neither a permanent insurance system nor a government prepared for the scale of the crisis approaching. The collapse began in 1929. The stock market crash did not instantly create every hardship of the Great Depression, but the contraction that followed spread through banks, factories, farms, construction sites, mines, and railroads. Businesses lost sales and credit. Production fell. Employers shortened hours, cut wages, and dismissed workers. By 1933, roughly 14 million Americans were unemployed, about 1/4 of the labor force. Millions more worked only part-time or at sharply reduced wages. As unemployment climbed toward 1 worker in 4, another pillar of self-reliance collapsed. Thousands of banks failed between 1930 and 1933, and before federal deposit insurance, a closed bank could take a family's accumulated savings with it. The worker who had followed every traditional instruction worked steadily, save carefully, avoid charity, could lose both the paycheck and the emergency fund. The Depression did not merely create poverty, it discredited the belief that individual prudence alone could ensure a household against a national collapse. For the individual household, the national statistics arrived as a series of small decisions. Stop buying meat, delay the rent, burn less coal, pull a child from school so the child can search for work, move in with relatives, sell the radio, pawn the wedding ring, skip the dentist, ask the grocer for one more week. Each decision protected the family for a little longer, but each also removed something that could not easily be restored. Men stood in lines outside factory gates because a rumor suggested 10 openings might appear. Families searched newspapers for positions that attracted hundreds of applicants. Unemployed workers traveled by freight train, walked between towns, or slept in improvised camps. Evicted families constructed shacks from scrap wood and sheet metal. Hunger existed beside warehouses, farms, and factories capable of producing abundance. The nation had not forgotten how to work. It had lost the mechanism that connected work, wages, and demand. The crisis became visible in forms that prosperity had rarely forced the country to confront. Men in worn business suits sold apples and pencils on street corners. Public libraries filled with people reading want ads and keeping warm. Employment offices drew crowds before dawn. The lines contained skilled machinists, clerks, miners, salesmen, and construction workers who had spent years supporting families. It became difficult to claim that millions of people from unrelated trades had simultaneously lost the desire to work. But the old system contained an impossible equation. The places with the most unemployed people were often the places with the least money available to help them. Herbert Hoover's administration emphasized voluntary cooperation, private charity, local responsibility, and measures intended to restore business confidence. Committees urged communities to organize employment drives and relief campaigns, yet encouragement could not recreate factory orders, taxable property, or charitable donations. As the Depression deepened, local governments borrowed, cut services, and expanded relief until many approached financial exhaustion. This produced a cruel fiscal trap. The communities with the most unemployed workers often suffered the largest collapse in property values, business activity, and tax revenue. Need rose while the local ability to pay fell. Cities reduced school terms, dismissed employees, postponed maintenance, and weakened public services in order to finance relief. Some curtailed assistance not because fewer families needed help, but because the Treasury could no longer support them. The burden was not shared evenly. Employers and relief officials often gave priority to male household heads, while married women could be treated as secondary earners even when their wages had supported a family. Black workers were frequently pushed out of jobs first and faced discrimination in both private hiring and local relief. The old system was discretionary at nearly every level, which meant that existing prejudices could decide who received work, who received aid, and who was told to rely on relatives who were already struggling. By 1932, the federal government began lending money for state and local relief. In 1933, the Roosevelt administration created the Federal Emergency Relief Administration and supplied direct federal grants to support cash relief, work relief, and other emergency programs. This was a historic transfer of responsibility. Unemployment had become too large to remain a local charity problem. Washington was now financing the survival of millions of households. Harry Hopkins, who administered the new federal relief effort, approached the emergency with a different sense of time. Hungry families could not wait for confidence to return or for a perfect administrative system to be designed. Federal money moved through states and cities to keep relief offices functioning, while short-lived work programs put people on public payrolls. These measures prevented deeper suffering, but they also revealed how expensive and improvised crisis relief became when no insurance reserves had been accumulated beforehand. But emergency relief was not unemployment insurance. Relief asked whether a family was needy enough to receive assistance. It could be adjusted, delayed, reduced, or conditioned by local administration. Insurance would ask whether a worker had sufficient covered employment, had lost the job under qualifying conditions, and remained able and available for new work. Relief responded after destitution. Insurance was supposed to interrupt the fall before destitution arrived. Public jobs were different again. The Civil Works Administration, and later the Works Progress Administration, paid people to perform useful work. Roads were improved, schools repaired, parks developed, records organized, art created, and public buildings constructed. Work relief preserved wages and dignity for millions, but it required the government to create a position. Unemployment insurance would operate between jobs, providing temporary income while the worker searched for another employer. Work relief answered a moral demand that remained powerful across the political spectrum. People wanted wages for useful labor, not a payment for remaining idle. Yet a public job program had to invent projects, hire supervisors, purchase materials, and decide where work would occur. It could employ millions during an emergency, but it could not become the ordinary response to every temporary layoff in every town. Insurance promised something narrower and faster, a partial wage bridge while the private labor market searched for a new match. The Depression therefore exposed three separate needs. The country needed emergency relief for families already without resources. It needed public employment when private employers could not supply enough jobs. And it needed an insurance system that would prevent an ordinary layoff from immediately becoming a relief case. The first two needs were being addressed through emergency New Deal programs. The third demanded a permanent structure that would continue after the crisis ended. The federal government also strengthened the Public Employment Service Network through the Wagner-Payzer Act of 1933. An employment office could register a worker, record skills, and direct applicants toward available jobs. What it could not do was manufacture vacancies in a collapsed economy or replace the wages missing while the search continued. This limitation later shaped unemployment insurance. Benefit administration and job placement were deliberately connected because the purpose was to preserve workers between jobs rather than detach them from work. Even organized labor had to reverse itself. National union leaders had often rejected unemployment insurance as a humiliating dole and demanded full wages through work instead. The Depression made that position impossible to defend. When millions of willing workers could not find jobs at any wage, receiving temporary insurance no longer meant admitting personal failure. By 1932, the American Federation of Labor endorsed unemployment insurance, removing one of the reform movement's most important obstacles. Wisconsin moved first. For years, economists and labor reformers associated with the University of Wisconsin had studied workers' compensation, unstable employment, and social insurance. In January 1932, the state enacted the first unemployment insurance law in the United States. Covered employers would build reserves, and benefits would begin only after enough money accumulated. The law proved that unemployment compensation could be written into American law. It also exposed why one state could never solve the problem alone. Wisconsin's design also reflected an early hope that insurance could prevent layoffs, not merely compensate them. Employer reserves were meant to make unstable employment more visible and give firms a reason to plan production carefully. But contributions had to build before benefits could be paid. So the law offered little immediate rescue in 1932. Its greatest achievement was conceptual. It transformed unemployment compensation from a reformer's proposal into a workable legal model that national policymakers could examine, criticize, and adapt. A Wisconsin employer could face costs that a competitor across the border avoided. Corporations operated in several states, workers crossed state lines, and every legislature had an incentive to wait for someone else. The reformers therefore needed a national mechanism that would remove the competitive penalty without turning unemployment compensation into one centrally administered federal program. The answer was the tax offset idea. Impose a federal payroll tax, then credit most of it back when an employer paid into an approved state system. The proposal turned the state's fear in the opposite direction. Before the federal tax, a legislature worried that unemployment insurance would burden local business. After the tax, refusing to create a state program would not spare employers. They would still send the money to Washington, while employers in participating states used a large credit to finance benefits for their own workers. A state remained legally free to refuse. Economically, refusal became difficult to defend. The person who had to turn that mechanism into a durable national system was Frances Perkins. When President-elect Franklin Roosevelt asked her to become Secretary of Labor in February 1933, Perkins did not simply accept. She laid out the program she intended to pursue: unemployment compensation, federal unemployment relief, a strengthened employment service, old age security, minimum wages, shorter hours, workers' compensation, and the abolition of child labor. Roosevelt's agreement was a condition of her entering the cabinet. Perkins had been preparing for this fight long before she entered Washington. As New York's industrial commissioner, she had pressed Roosevelt, then governor, to support unemployment insurance and traveled to Britain in 1930 to study its compulsory system. She returned convinced that America could not simply copy the British model, but also convinced that unemployment was too predictable to remain a matter of improvised charity. By 1933, the policy was not one item on her agenda. It was a commitment she had carried into the cabinet. Perkins understood both the urgency and the trap. Emergency relief could feed families now, but it would disappear with the emergency. A permanent federal program might be politically impossible or constitutionally vulnerable. A loose collection of state laws would leave employers and workers with radically different protection. When Roosevelt created the Committee on Economic Security in June 1934 and placed Perkins in the chair, he gave the committee only months to design a system that balanced all three problems. Edwin Witt, a Wisconsin economist and administrator, became executive director. Arthur Altmeyer and other specialists worked through the technical structure. But the essential conflict was political. Should the nation create one federal insurance program or 48 state programs? Should workers contribute or only employers? Should each company maintain its own reserve? Or should risk be pooled? How generous could benefits be without exhausting funds? And could any design survive a Supreme Court that had already struck down major economic legislation? The committee worked under a brutal clock. Roosevelt wanted recommendations before the next congressional session, while the country was still supporting millions through emergency programs. Economists produced projections, lawyers tested constitutional theories, labor representatives argued over dignity and eligibility, and business representatives warned about costs. The federal-state compromise survived not because everyone considered it ideal, but because every cleaner alternative threatened to lose a necessary part of the coalition or collapse in court. These questions were not bureaucratic decoration. They determined who would pay, who would qualify, and whether the system could exist at all. Harry Hopkins, running federal relief, knew insurance could not help the millions already unemployed because no reserves had been accumulated for them. Perkins and Witt knew that waiting for the next depression would repeat the same disaster. The country needed relief for the present and insurance for the future, built during recovery before the next mass layoff arrived. Roosevelt sent the economic security proposal to Congress in January 1935. Employers, conservatives, states' rights advocates, and lawmakers protecting particular industries attacked different parts of it. Some demanded a fully federal plan. Others wanted maximum state control. Congressional compromises preserved broad exclusions that supporters often defended as administratively necessary. Whatever the stated rationale, the practical effect would be unequal because agricultural and domestic work employed disproportionate numbers of black workers and women. Yet the Depression had made one old argument impossible to sustain: family, charity, and local relief were clearly not enough. The bill therefore moved through Congress as both a promise and a bargain. Supporters described unemployment compensation as earned protection rather than charity. Opponents warned of bureaucracy, higher labor costs, and federal intrusion. Industries sought exceptions, states guarded administrative power, and lawmakers altered the boundaries of coverage. What emerged was not the most generous system reformers could imagine. It was the system they believed could pass, survive judicial review, and induce every state to build an agency before political urgency faded. On August 14, 1935, Roosevelt signed the Social Security Act. The law is remembered mainly for old age benefits, but unemployment compensation was one of its central pillars. Title II imposed a federal payroll tax on covered employers. Title III supplied federal grants to help states administer approved unemployment laws. Washington created the pressure and financed administration. The states designed and operated the benefit systems. The original tax generally applied to employers with 8 or more workers. It began at 1% of covered wages in 1936, rose to 2% in 1937, and was scheduled to reach 3%. The crucial provision allowed employers a credit of up to 90% for contributions paid under an approved state law. That credit was the hidden engine of the entire system. It created nationwide pressure without creating one identical nationwide benefit. The money did not simply disappear into the general federal budget. State reserves were held in separate accounts within the Unemployment Trust Fund at the Treasury, while federal grants paid approved administrative costs. State programs also had to connect compensation with public employment offices and provide basic procedural protections. The design reflected the original goal: a temporary bridge for a worker attached to the labor market and searching for another suitable job, not permanent income outside work. The protection was still far narrower than a modern viewer might assume. The federal tax base excluded agricultural labor, domestic service and private homes, many nonprofit and government workers, certain maritime and family employment, and workers at employers below the size threshold. Millions of people therefore began outside the system. The new safety net was real, but from its first day it contained the inequalities and political compromises of the economy around it. Nor did the law produce checks in August 1935. States had to pass legislation, collect contributions, hire staff, create wage records, connect employment offices, and let reserves accumulate. Early state laws added waiting periods, wage tests, weekly maximums, limits on duration, and rules for voluntary quits or misconduct. The people already suffering in the depths of the Depression still depended on relief and work programs. Insurance was being built for the next layoff as much as for the current emergency. The tax credit deadline moved the states with extraordinary speed. Refusing to pass a law would no longer protect local employers from cost. It would simply direct more of their money to Washington. By the summer of 1937, all 48 states, the District of Columbia, and the then territories of Alaska and Hawaii had an approved unemployment compensation law. The cooperative system had spread across the country in roughly 2 years. Its survival was not guaranteed. The Stewart Machine Company of Alabama paid the federal tax and sued for a refund, arguing that the credit coerced states into surrendering their authority. On May 24, 1937, the Supreme Court upheld the structure in Stewart Machine Company v. Davis. Justice Benjamin Cardozo treated it as legitimate federal-state cooperation against a national problem. The tax created an inducement, but states retained a legal choice. The architecture had survived its most dangerous test. A 5-4 decision the other way could have dismantled the mechanism after states had already reorganized their laws around it. The court's approval did more than settle one tax dispute. It confirmed that mass unemployment was not merely a collection of local misfortunes. It could become a national emergency requiring coordinated fiscal action, even when benefits remained under state administration. The constitutional answer matched the economic lesson of the Depression. State borders could organize the response, but they could not contain the cause. The timing mattered because the economy weakened again in 1937 and 1938. New state agencies had to begin operations during another serious contraction. In the first 6 months of 1938, about 2.5 million workers received nearly $180 million in unemployment compensation in the 25 states then paying benefits. By the end of June, roughly 1 million people were receiving weekly payments averaging about $10. $10 was not a replacement paycheck, and the program did not cover everyone. Benefits were temporary and tied to recent covered employment. A claimant generally had to be involuntarily unemployed, able to work, available for work, and searching for suitable employment. Someone who lacked enough wage credits, worked in an excluded occupation, exhausted benefits, or failed a state rule could still end up on relief. The new system built a floor, not a complete shelter. But that floor changed the sequence of disaster. Before insurance, a layoff could push a worker immediately from payroll to family dependents, charity, pawn shops, and the poor relief office. A qualified worker now had a period in which some purchasing power continued. The family might keep paying part of the rent and buying groceries while another job was sought. The benefit did not make unemployment comfortable. It placed time between the loss of the job and the loss of everything else. The effect spread beyond the claimant. When thousands of laid-off workers continued spending part of their former income, grocers retained customers, landlords received more rent, and local merchants lost fewer sales. Money returned to communities precisely when private payrolls were shrinking. Unemployment insurance became an automatic stabilizer, far too small to stop a depression by itself, but capable of slowing the spiral in which lost wages produced lost spending, which produced still more layoffs. The financing principle also changed who absorbed the cost. Under the old order, the worker and family took the first loss, charities took part of the next, and local taxpayers paid after destitution appeared. The new system collected money during employment, so part of the cost of layoffs could be paid when work disappeared. Unemployment remained painful, but it was no longer treated entirely as the private failure of the person who lost the wage. The federal-state compromise carried a permanent price. Because states retained control over benefit formulas, eligibility rules, tax structures, and administration within federal standards, protection differed across state lines. Coverage expanded over time, and Congress repeatedly added extended benefits or temporary federal support during severe recessions. Yet self-employed, irregular, and non-traditional workers have often remained difficult to protect. The same flexibility that made the system politically possible also made it uneven. Every major downturn has tested the boundary recognized in the 1930s. Insurance works best for temporary unemployment among people with recent covered wages. It strains when joblessness lasts longer than ordinary benefit periods, when an entire industry contracts, or when millions of workers fall outside standard payroll definitions. Then the country again reaches for emergency extensions, federal supplements, public spending, or direct relief. Insurance and relief became separate tools, but neither made the other unnecessary. Return to the machinist outside the factory gate. Before 1935, his next steps depended on whatever private resources remained around him. He could ask relatives for money, plead with the grocer, sell possessions, visit a charity investigator, apply for local relief, or join a line for an emergency public job. None of those paths existed because his employer had contributed to a system while he worked. After the new framework matured, another path existed. A covered worker could report to a public employment office, establish a recent wage history, explain the separation, continue searching for suitable work, and receive temporary compensation from a state fund operating within the federal-state framework. The payment did not erase the layoff or promise a full wage. It preserved a measure of independence while there was still another job to find. That is the real meaning of 1935. America did not learn how to prevent every layoff. It changed the category into which unemployment fell. A risk once treated mainly as personal bad luck, moral weakness, or local poverty became a recurring feature of an industrial economy that could be measured, financed, and partially insured. The old system improvised only after destitution appeared. The new one collected money before the next downturn. The system remains incomplete. Benefits are temporary, state rules vary, and severe national crises still require federal reinforcement. But the question facing the worker at the gate is no longer answered only by the generosity of relatives, the budget of a city, or the judgment of a charity office. There is an institution built around the possibility that a willing worker can be unemployed through no personal fault. Before 1935, the American safety net usually appeared only after the fall. Unemployment insurance tried to catch the worker earlier, while there was still rent to preserve, food to buy, and time to search. It never promised that losing work would be painless. It promised that one decision behind a factory gate would not have to destroy an entire household before the worker had a chance to begin again.